Hi, I'm Adam Taggart, co-founder of PeakProsperity.com. For those of you with money invested in the market, like a brokerage account or perhaps a 401k through your work, this short video is going to explain why now is a particularly important time to play it safe with your money. Let's begin with a pop quiz. How far did the stock market eventually fall in the wake of the crash that began in 2008? By the time the S&P 500 index bottomed out in March of 2009, it was 57% lower than its October 2007 peak. Wow, 57%. That's brutal. Over half of the wealth owned by the nation's stock investors vaporized in a little over a year. And a brutal time it was. The U.S. housing bubble was in the process of bursting, with home prices falling a full third from 2006 to 2008. Unemployment was skyrocketing, as hundreds of thousands of workers were laid off each month. People lived with a visceral fear that their wealth might never recover from these blows. And that was an understandable assumption. Think about it for a moment. If, like the market index, your investment portfolio had dropped by over 50%, it would need to more than double just to get back to even. Ugh. Assuming you were able to enjoy a 6% return on your portfolio every single year from then on, how long would it take you to recoup your losses? Well, the rule of 72 tells us that it would take at least 12 years. Double ugh. Now, of course, we all know how this story played out. The U.S. Central Bank, the Federal Reserve, stepped in to inject increasing amounts of stimulus into the economy, buying up trillions in financial assets through a succession of purchase programs known as quantitative easing. When all was said and done, the Fed ended up more than quintupling its balance sheet. For the layman, the Fed acted as a backstop, as a buyer of last resort, giving out a lot of money in order to vacuum up these bad assets. Eventually, investors stopped being nervous and were willing to start buying again, confident that the Fed had their back and would step in again to prop up prices. While this kind of continuous safety net violates the Darwinian rules essential to free markets, Wall Street was thrilled. After hitting its low in March 2009, the S&P 500 went on an upwards rocket ride. All of that free, thin-air money the Fed and its central banking brethren were pumping into the markets had to go somewhere, and, as intended, it propelled the prices of stocks, and bonds, and real estate higher. By 2013, the markets surpassed their pre-crisis highs, but the stimulus programs continued, sending asset prices higher still over the next few years. And this is the world we've been living in, where economic growth around the world remains anemic, making the central banks reluctant to turn off the supply of liquidity that the financial markets have become addicted to. But the trillions and trillions of new money sloshing around from all of that stimulus has sent the prices of stocks, bonds, and housing back into bubble territory, in most cases, well above their pre-crisis bubble highs, and creating a massive wealth gap between the top 1% and everybody else. We're stuck at a point where additional stimulus simply inflates these bubbles further, increasing the pain and severity these bubbles will wreak when they pop. But withdrawing liquidity will send the economy quickly into recession, pricking these asset bubbles as it does. The central banks are damned if they do and damned if they don't at this point. Looking back at the S&P, it's clear that we're seeing diminishing returns from the Fed's efforts. The explosive rebound seen from 2019 to 2013 has moderated. In fact, the index is only marginally higher than it was in November of 2014, meaning it's hardly gone anywhere over the past 2 years. In this chart prepared by Charles Hugh Smith, he shows us how the index is trading in a tightening wedge, and the technical indicators suggest that when it breaks out of that wedge, it's more likely to break to the downside with vigor. Now we get to the main point of this video. In a market where prices have been perverted upwards for years, as we've just explained, does it make sense to continue to bet on this trend when it appears long in the tooth? Or is it wiser to seek safety? Behavioral science actually has an answer for us. As biological organisms, we're motivated by pain and pleasure, but not in equal measure. Turns out, we value avoiding pain or loss more than we do pleasure or gain. As behavioral economist Daniel Kahneman proved, this preference for loss avoidance was likely a success factor in our evolution as a species. And through what's called prospect theory, science also tells how much more we prefer losses to gains. About twice as much. What this means is that losing 10% of your wealth feels twice as bad as growing at 10%. So, with record bubble valuations in stocks, bonds, and real estate that are showing signs of increasing instability, and armed with the knowledge that a future market crash will hurt twice as much than if prices magically jump from here, which choice would a rational person make? Take steps to safeguard your wealth against a coming correction? Or remain fully invested and long the market, what some might call picking up nickels in front of a steamroller? The choice should be obvious, but if it helps, consider this chart from the Economic Policy Institute. It shows how when big market losses occur, it's the individual investor who feels the pain most. Remember how much the S&P index rebounded after 2009? Well, most of those gains went to the big institutional investors and wealthy elites who had spare capital to invest. In contrast, the retirement portfolios of most regular U.S. households, as well as their risk tolerance, were so badly damaged that years later, values are still well below their 2007 peaks. Don't let that happen to you. Share this video with your financial advisor and ask for a plan to limit your losses should another 2008 style, or larger, market correction happen again. Should you have trouble getting the answers you like, or finding an advisor willing to address your concerns, consider scheduling a consultation with the advisor Peak Prosperity endorses by visiting greylockpeak.com. It's completely free. Now is the time to focus on avoiding losses and to prioritize the safeguarding of your wealth. Good luck, and thanks for listening.